Hello everyone, Elliot Yu here with the Free Market Speculator and the Energy Bulletin. Welcome to my Sunday Deep Dive. In this weekly video, we look at a key chart, trend, or indicator that caught my eye over the past week, and I explain what it means, or at least what I think it means for financial markets. Now, the S&P 500 hit an all-time closing high on June 2nd, a little over a month and a half ago. As of Friday's close, that's July 17th, we're down about 1.9% from that peak. So, not a big sell-off, but no real headway either, right? However, while the S&P 500 is essentially drifting sideways just under those early June all-time highs, there's a ton of action going on just under the surface. Now, this chart shows the performance of various sectors and market indices since that June 2nd broader market high. And as you can see, the S&P 500 is down 1.89%, as I said, about 1.9%. That's the red bar. And if you move down the chart from there, you'll see that where the real weakness is. The S&P 500 Technology Index down 11.3%. Software stocks down almost 11.4%. And semiconductors down almost 12%. Meanwhile, look up towards the top of my chart and you'll see a ton of strength. Healthcare stocks, a group we've been adding to in the model portfolio of this service lately, that's up 10.5% since that June 2nd broader market top. Financials are up 9.71%. Real estate, utilities, and industrials are all nicely higher. Even the S&P 500 Equal Weight Index, which weights all stocks in the S&P 500 equally rather than by market capitalization, well, it's up almost 2%. Dramatically outperforming the S&P 500, while the Russell 2000 index of small cap stocks, it's up about 1.1%. Just over the past week now that's since the close on Friday, July 10th, the S&P 500 is down about 1.5%. However, look at this chart. Energy stocks had a great week last week, up close to 5%. Financials performed well overall, straight through quarterly earnings announcements from some of the largest banks in the S&P 500. Real estate, staples, and healthcare also all positive on the week. Simply put, market breadth is improving while the market is selling off. That's a sort of mirror image of what we've seen many times in the past 3 years, where the broader market averages have rallied, supported by a relatively small number of stocks, those with the biggest index weights generally. One of my favorite measures of market breadth is to look at the percentage of S&P 1500 stocks, 1500, not the 500, trading above their respective 200-day moving averages. Now, the S&P 1500 is an index that includes the S&P 500, of course that's the large capitalization stocks, as well as the S&P 600 index of small cap stocks, and the S&P 400 index of mid-cap stocks. So it's a pretty broad index of US stocks. Now here's a chart showing the SPDR S&P 500. That's an ETF that trades under the symbol SPY, SPY, and that tracks the S&P 500. That's the blue line. The red line shows a percentage of stocks in that much broader S&P 1500 index trading above their 200-day moving averages. That's our measure of breadth. Now, what's really fascinating here is that, as I said, the S&P 500 has been trading sideways since early June, and I've labeled that with an arrow here, while market breadth is continuing to improve and move higher. Specifically, when the S&P 500 was hitting those all-time highs in early June, a little under 60% of S&P 1500 stocks were trading over their 200-day simple moving averages. As of Friday's close, July 17th, around 71.8% of S&P 1500 stocks were over their 200-day moving averages. And look at this one. This chart shows market breadth on this basis since the end of 2022. So you can see we have not seen breadth this solid since the summer of 2024, nearly 2 years ago. Of course, if you've been around financial markets for long enough, you've probably heard claims that markets that rise on weak breadth, supported by relatively small number of stocks and industry groups, they're fundamentally unhealthy, while rallies supported by a large cross-section of stocks and sectors, well, they're more healthy, more durable. However, that simple rule of thumb lacks detail and leaves several key questions unanswered, including these four. First, How exactly do we measure market breadth? Second, what exactly constitutes good market breadth versus bad or deteriorating market breadth? Third, is there any correlation between market breadth and forward stock market returns and stock market volatility? Fourth, how does breadth actually behave ahead of stock market pullbacks, corrections, and bear markets? So in this week's Sunday Deep Dive, I'm going to dive into the data on market breadth, try to answer these 4 questions, and develop a simple early warning system. It's a traffic light signal, a red, yellow, and green light dashboard, if you will, for market corrections based on breadth data. Let's start with this. This table uses the same measure of breadth we just examined. That's the percentage of S&P 1500 stocks trading above their 200-day simple moving average, SMA, on any given trading day. This is a simple measure of market breadth that's worked for me in the past, and it's something I've written about before in this service. This table shows the correlation between a particular trading day's market breadth and forward returns and volatility for the S&P 500 on a price-only basis over 1 week to 12-month holding period. So wide range of forward holding periods. So we're using the broader S&P 1500 to measure breadth and the more familiar S&P 500 to measure returns. In my experience, this is actually how a lot of investors think about market breadth, right? Strong market breadth is supposed to imply strong positive forward returns, and vice versa. I use 2 different measures of correlation here, but they're both interpreted in basically the same way, ranging from -1 to +1, with the former, -1, indicating perfect inverse correlation and the latter the opposite. So 2 key takeaways from this table. All the forward return correlations are negative and close to 0. So what that means is that strong current market breadth actually tends to be associated with weaker, not stronger forward returns from the S&P 500. However, these numbers are really so small in absolute terms that the real interpretation is probably more that there is little or no significant correlation between current market breadth and subsequent returns. So, contrary to what you may have seen or read over many years, weak breadth does not mean a weak market, nor does strong breadth imply above average returns from the S&P 500. Now, as I'll illustrate in a moment, the relationship between market breadth and returns, it's more complex, and it's nonlinear. The volatility findings are more interesting here, as they're all significant negative numbers. So the interpretation of that is that stronger market breadth, right, higher market breadth, higher percentage of stocks trading over their 200-day moving averages, that's consistent with lower forward market volatility, right? What's interesting is that while the inverse correlation is strongest for shorter forward holding periods, so 1 week out to about 3 months, it actually persists all the way out to at least 12 months into the future, which is the longest time period I looked at. And since market volatility is generally consistent with, when you have higher market volatility, that's generally consistent with higher incidences of market corrections and pullbacks, right? A tougher market, if you will. This is an interesting finding that I'll cover a bit more a little bit later on in this update. First, look at this. Hopefully you can see this table on your screen. If not, don't worry, as I'll add a link that will allow you to download all my slides and charts as a PDF file below. This data is based on the same list of stocks over the same period. Now, instead of performing a simple correlation, I divided market breadth into quintile buckets. So that ranges from less than 20% of stocks trading over their 200-day SMAs, that's terrible breadth, to 80 to 100% of stocks trading over their 200-day SMAs, that's very good breadth. Looking at returns, this test shows far more interesting results than our first one. The average rolling 3-month return from the S&P 500 on this basis is about 1.99% for the entire sample size. So what you can see here is that forward returns for the S&P 500 are actually strongest when breadth is weakest. When fewer than 20% of these 1,500 stocks are trading above their 200-day SMAs, the mean 3-month forward return is 6%, more than double the full sample average, actually triple the full sample average. And the mean 12-month forward return, it's about 29.3%, also well above average. While that might seem counterintuitive at first glance, it's not. Think of periods like 2009, stock market lows, or even the tariff panic in the spring of 2025, last year, right? When markets get slammed hard like that, most stocks will be extended to the downside, so you do tend to see impressive snapback rallies. So it's basically a function of the old saw attributed to Rothschild, right? Buy when there's blood in the streets. So also note, though, that the weakest returns tend to be from sort of middling breadth. Strong breadth, 80 to 100% of stocks over their 200-day SMAs, that also tends to be associated with above average returns, particularly over a 12-month holding period. So essentially, the negative correlation between current breadth and forward returns we calculated in that first table I showed you, that hides a much more complex nonlinear effect. When breadth is an extreme low, associated with panic lows in the broader market, forward returns are exceptional. Forward returns are also good at the other extreme. Very strong breadth, and they're rather uninteresting, kind of around average, apart from those extremes. Also note that the inverse breadth volatility effect we uncovered in that first table, well, that's still very much alive here. The weaker market breadth is, the more volatile stocks are on forward 1-month, 3-month, and 12-month holding periods. The volatility falls in a rather steady fashion from quintile 1, that's the weakest breadth at the top of my table, down to quintile 5, strongest breadth at the bottom of the table. So let's move along. I decided to take a look at two different measures of market breadth based on the volume-weighted average price, or VWAP indicator. So let me explain what exactly that is. I've written extensively about the 200-day simple moving average before in this service. That's just the average closing price of a stock or index over the past 200 trading days. However, the simple moving average weights every close equally, right? No matter how far back in the past it is. It's a simple mean calculation, averaging. However, it stands to reason that if we see an explosion in trading volume around a specific price level, right, that should impact the importance of that level as a technical support or resistance point, a point on the chart that's meaningful. Enter volume-weighted average price, VWAP, and specifically anchored VWAP. So take a look. This chart shows the SPDR S&P 500 ETF from the middle of October 2024, that's just before the presidential election that year, through the spring 2025 tariff panic, and then through the end of 2025. Now that's the blue line there, that's just the SPY, and the green line is the 200-day simple moving average, right? Calculated by averaging the closing prices over the past 200 trading days. Now that brings me to that orange line you see, which represents the volume-weighted average price anchored to February 19th, 2025. That was a 52-week high for the S&P 500 at that time, right? And the peak just before the tariff sell-off. Now I'll leave the exact calculation of VWAP to a future issue or video. For now, it's just important to understand that this line incorporates both the intraday range for SPY, high and low, right? As well as the volume of the ETF traded each day over this period, starting on that anchor date, in this case, February 19th, 2025. Now, there are 3 points to note. First, stocks fell sharply from that February 19th peak, falling below the 200-day moving average on March 10th. Ultimately, SPY bottomed on March 13th, 2025, and then saw a weak bounce that peaked on March 25th, 2025. Notice that the S&P 500 rally failed almost exactly at that range bounded by the anchored VWAP and the 200-day simple moving average line on the chart. After failing right into that key technical level, SPY sold off sharply to mark a closing low on April 8th. After that, of course, stocks enjoyed an impressive, powerful rally through the summer of last year before the market turned choppy again into early 2026. Regardless, what's interesting is that VWAP indicator, that orange line there, gave you an earlier recovery signal than the traditional 200-day simple moving average. SPY crossed above that February 19th VWAP on April 25th when it closed at 543. Meanwhile, if you waited until the SPY crossed over its 200-day simple moving average to flash an all clear for the bulls, that didn't happen until May 12th at about 574.90. So that's almost 6% higher level. So we can use these VWAP lines anchored to an individual stock's 52-week high and its 52-week low. So two different ways of looking at it to create alternative breadth measures, right? Specifically, the AVWAP from high that I quote on this table, that measures the percentage of stocks in the S&P 500, in the S&P 1500 rather, that are trading above a VWAP anchored to their own, right, stock-specific 52-week closing highs. The AVWAP from low measures the percentage of stocks in the S&P 1500 trading above a VWAP anchored to their own 52-week lows. Rather than dividing the data into absolute levels, I'm measuring each breadth metric relative to its own history. 0 to 10% would represent the very weakest decile of breadth on each metric independently, while 90 to 100% would be the strongest 10% of breadth readings over the past 26 years. So this helps make these three different measures of breadth we're looking at comparable to one another, because we're not looking at absolute levels for any of them. We're looking at where they're trading relative to their own history. Now I've included both AVWAP breadth measures as well as the 200-day moving average based breadth measure I highlighted earlier. We're looking only at mean returns in this case for the price-only S&P 500 over 3 months, which compares to, again, that full sample average 3-month return of 1.99%. I will circle back to volatility here in just a few moments, but now we're just looking at forward returns. There are a few distortions in the pattern here. However, there remains a kind of general U-shaped relationship, right, between stock market breadth and forward market returns. When breadth is very weak, forward returns tend to be elevated, which represents that panic oversold snapback effect we outlined earlier. There's a dip in the average returns in the middle of the percentage distribution, those percentiles, followed by strength in returns starting from elevated breadth readings. Now, most readers have heard of breadth thrust signals, such as the Zweig breadth thrust signal. So that's a ZBT, we call it. I've written about this in this service previously, right? Forward market returns from ZBT signals are very strong, right? It's a very good signal. However, the signal it's pretty rare. So one interesting pattern I did uncover, it is a breadth thrust based on that VWAP low breadth measure I outlined earlier that fires more frequently, 82 times since the start of my sample, which, as I said, is 26 years ago. Now here's how it's defined. Okay, so the VWAP from low breadth drops into the bottom 10% of its own history, followed by a climb back above the 20th percentile. So it gets really weak breadth and then a little bit of a snapback. The unconditional baseline, so this is just the returns from any randomly selected date in the history, right? And I've got that for the mean return and the percentage of positive returns, the hit rate for the S&P 500 over the full sample over holding periods from 1 month to 12 months. Now, as you can see, so I've got that on this table. Now, as you can see, following the AVWAP thrust signal I just outlined, the mean returns from the S&P 500 are far higher than average, while the win percentage or hit rates are slightly above average. The last time this signal fired was on March 27th, 2026, about 3.5 months ago. And over the 3 months following that signal, up until late June, right, the S&P 500 was up more than 16% on this basis. So that is something worth watching for the future. And that brings me to what I believe is the most useful way of all to look at this breadth data. This is the core of this video, if you will. Specifically, it's a correction or bear market early warning system we can use to help flag periods of elevated risk for corrections, pullbacks, and market volatility, broader market volatility. Now take a look. To create this table, I moved back to the percentage of stocks above the 200-day simple moving average as my breadth metric. Specifically, what we're looking at is the market breadth on a given trading day on this basis, coupled with the probability of a 7% or larger correction in the S&P 500 over the ensuing 3 months, measured from the close on that trading day. So rather than measuring forward returns in isolation, just looking at how the market performed over the ensuing 3 months, we're measuring if weak market breadth today means anything about the risk of a significant pullback in stocks from today's closing level at any time over the next 3 months, right? So we're looking for the probability for a pullback of 7+% in the S&P 500 over 3 months, rather than just the return over that sort of random 3-month period. So the probability of a 7% plus pullback in the S&P 500 over 3 months from any random day in my sample, that's 25.2%, about 1 in 4. That's the baseline. And what you can see in my table is that breadth is very useful in this regard. For example, when market breadth on this basis is at or below 40%, right, of stocks trading above their 200-day SMAs, the probability of a 7% correction from the current close anytime over the next 3 months, well, it's 43.6%. That's a whopping 1.73 times, almost 1 3/4 times the baseline risk. And at below 60% breadth, right, the probability is still elevated at 37%, about 1.5 times the baseline. Now look at the right-hand half of my table, right? This represents the probability that realized market volatility, a proxy for risk, will be in the upper quartile of all observations since 2000, right? So going back over a long time period. You can see the same breadth effect here. For example, with a breadth reading of 50% or lower, there's near 62% probability of elevated market volatility over the ensuing 3 months. Okay, so that's compared to a 25% baseline. Equally useful is to look at this table in reverse, right? So the break point here is between 60 and 70%. So if breadth is at 70% or higher, the probability of a 7% or larger correction plummets all the way to 14.9%, which is 10 plus full percentage points below the full sample average. Meanwhile, the probability of a top quartile volatility accident, well, it's only about 8.7% over 3 months, about 1/3 the baseline mean. Now, as I noted, despite recent weakness in the S&P 500 from that June 2nd high, 71.8% of this broad list of stocks are trading above their respective 200-day simple moving averages. Breadth is near the strongest it's been in 2 years. So let's answer the key question. Does that mean forward market returns are likely to be high over 1 month, 3 month, and 12-month holding periods? Actually, it does not. Regardless of whether you look at breadth on this basis or using one of my VWAP metrics, we're currently sitting at an elevated but not an extreme reading, right, for breadth, which means that forward returns from here are generally close to the baseline average. What it does mean is that historically, from a position of solid breadth, such as we're seeing today, market volatility is lower than average, and the probability of a significant correction of 7% plus is below the long-term average. The warning sign would come if breadth were to drop below 60% on this basis. So here's a traffic light guide for you. As I said, we're currently in the green zone, below average risk of correction or a high volatility market accident. A move to the 60 to 70% range would put us in a yellow or amber light regime, if you will. That's just below the current level. Correction risks and volatility in that level, in that range, they're around or slightly below that full cycle average, full sample size average. Now, sub 60%, that's the red zone, where we have elevated risk of a correction or a nasty volatility explosion, such as we saw earlier this year, or even more so back amid the tariff panic in 2025. What's interesting to me here is that breadth tells us more about forward market volatility and stock market risk, the risk in the stock market, than it does about returns, okay? In my view, this supports the historical interpretation of market breadth in a way that I think a lot of investors don't think about it, right? And that's generally that breadth generally leads price. In other words, even if the market is hitting new highs or sitting close to all-time highs, a deterioration in breadth below that 60% threshold, that signals that perhaps it's time to pull in your horns a bit and raise some cash. In those environments, the probability of a major correction rises. Now let's take a look at recent market episodes to see how this red light, yellow light, green light framing works in practice. Now here's a chart of the S&P 500 ETF depicted as a thick black line from August 2023 through the end of June last year, 2025. The red, pale yellow, and green shading shows where market breadth was trading over this period. When more than 70% of S&P 1500 stocks were trading above their 200-day simple moving averages, you see green shading. Under 60% is red shading, and between 60 and 70% is yellow shading. Now, I will say this framework is more about flagging elevated risk of potential corrections and market volatility. It's not about flagging market lows. It's not particularly useful for that in this form. But it is about flagging market peaks. It's, as I said, an early warning system for corrections, pullbacks, and volatility. Now, breadth was weak amid the correction in late 2023, and then improved as the market rallied into year-end. After a major sell-off, such as we saw in the summer and autumn of 2023, it takes time for breadth to recover and move out of the red light zone. But that did happen in late 2023 and early 2024, as we moved into a yellow light zone and then into a green light zone in early 2024. For most of 2024, the market remained mainly in a green light zone, strong breadth, interspersed with some periods of yellow light zones. There's very little red here. Only a brief red danger zone there amid the collapse of the yen carry trade, the Japanese yen carry trade, in late July and early August of 2024. However, you can see how we began to see a shift at the end of 2024, right? Can you see that there on the chart? We moved into yellow and then saw some danger zone breadth red towards the end of the year. And while we did not see a move into, while we did see a move back into the yellow zone in January, February 2025, we never actually saw breadth climb back over 70% into that green zone, even as the market climbed to fresh all-time highs in February of 2025. So this was a very good early warning system of the nasty sell-off and explosion in market volatility we saw that spring. Well, the market actually continued to rise a bit as breadth began to deteriorate there in late 2024 and into early 2025. The gains were far harder to come by, and the market was much choppier than it was through most of 2024 when breadth was consistently positive in that green light zone. So here's the current situation. Now this chart is just the S&P 500 overlaid with the same traffic light breadth zones, those red, yellow, and green light zones over the past year. Now, as you can see, we had a lot of weak breadth through the correction this past spring, in the spring of 2026 now. But we moved into a yellow zone by early June of this year, and more recently, we're seeing more green zone breadth than we've seen since January, about 6 months ago. As I said, right now, this situation looks bullish, despite the lack of upside in the S&P 500 since early June, since it hit those highs on June 2nd. The longer breadth remains around 70% or higher, the lower the risk of a correction later this summer or into the autumn midterm election season here in the US. However, there's also a chance we see breadth fall back below 70% more consistently, or even worse, fall below 60% later this summer into that red zone. Should that happen, it would start to be a signal to maybe start de-risking, as we could be in for a more meaningful correction this autumn, particularly into that sort of midterm election or that seasonally weak period in September into early October. Now, more specifically, the problem for markets right now isn't that the broader tape looks heavy or that stocks are falling. They're not. The problem is that the market's erstwhile leadership groups, technology, and particularly semiconductor stocks, well, those are falling. These are widely owned stocks. They have heavy weights in the S&P 500, and they get more than their fair share of coverage, of course, in the mainstream and financial media. I'm talking about stocks like SpaceX, for example. Meanwhile, just under the surface, while there are way more sectors and stocks that are doing well, right? So the key has been, and I believe will remain to focus on the groups and stocks that are doing well, rather than watching the media drone on endlessly about popular, hot narrative stocks or popular sectors. In this service, we've been adding to our healthcare exposure since late June, including unveiling 3 new recommendations in the biotech sector just last week, one of which is already up 5%. Now, I'll link to that article below this video for those of you who have not seen it. But basically, the way we're approaching this group is that I've identified 5 biotech and life sciences focused hedge funds that have long and very solid track records specializing in this industry. So I track their holdings using their 13F filings at the SEC every quarter. And what I look for a number of different patterns, really. But generally, I'm looking for names, for companies that are being accumulated by one or more of these funds, or that represent significant new positions in a fund, a particular fund or group of funds' core research areas within these sectors. In addition to that, we also added to our basic materials exposure back on June 1st in a stock that's already up over 7%. And that's a stock that, as I said, we added on June 1st. We added it to the model portfolio on the day before the S&P 500's closing peak on June 2nd, all-time closing high on June 2nd. Yet it's still up 7% with the S&P almost down 2% since that time. Of course, we also have significant exposure to energy stocks, which are on the move higher again, and particularly over this past week. And I think they're going to continue to move higher through the balance of the year. This is a theme we'll be covering in more depth in an energy-focused issue out over the next week. So there you have it. Except at extremes, there just isn't much of a relationship at all between current market breadth and forward market returns, which I think is how most people think about this. However, breadth is very useful for flagging elevated risk of a serious broader market correction or a nasty explosion in market volatility. Now, I outlined a simple red light, yellow light, and green light framework for how to think about all this, how to think about breadth, and how breadth evolves over time. Now, finally, I explained how right now we are in that green light zone, and there are plenty of opportunities for investors willing to look beyond the popular groups like semiconductors that are the focus of so much media and investor attention out there. In a future post or video, I'll also outline an interesting sort of doom pattern in market breadth that we tend to see ahead of major bull market tops. I'm talking about generational highs like 2007 or 2022, or ahead of major sell-offs like we saw in the fourth quarter of 2018, right? We're not at risk of that pattern right now, I should tell you, but it is something to keep on your radar screen if you want to understand what to look for as this bull market ages and as we near the end of it, what to look for ahead of a market top, a real big bull market top, the beginning of a bear market. So with that in mind, thanks for listening. I hope you enjoyed this week's Sunday Deep Dive. If you enjoyed this week's video, please drop me a like or a comment. Really helps out with the algorithms both here and on YouTube. And you can subscribe for free to make sure you receive this weekly video and my other posts and updates when they're released. If you'd like to give the paid tier of Free Market Speculator a try, including our popular Energy Bulletin Top 10 model portfolio, I am offering 14-day free trials for a limited time via the link I'll throw down below. So I'll see you next week for another episode of my Sunday Deep Dive. Thanks again for listening.